Welcome back to the Deep Dive. Today we're digging into the Toro Company, ticker TTC, after their Q4 and full year 2025 earnings call on December 17th. And this one, it was interesting. We saw this big initial stock pop, but then it faded pretty quickly. So there's clearly a lot of nuance for us to unpack here.
Oh, absolutely. That market reaction is the whole story. You know, if you just looked at the headline beat, you'd think everything was perfect.
Right.
But this was really a quality of earnings story. It's all about management proving they can control costs and generate cash, even when their end markets are pretty mixed.
Okay, so let's start there. Let's get into those headline figures. For Q4, they beat on both revenue and earnings.
They did. Revenue came in at $1.07 billion, just ticking above the $1.05 billion consensus.
And that earnings beat was pretty solid.
Yeah, very solid. Adjusted EPS was 91 cents, which was almost a 6% beat over the 86 cents the street was looking for.
But you have to talk about the gap between that adjusted number and the GAAP EPS, which was way down at 74 cents.
That's a 17-cent gap, and it's a huge one. But you have to understand why it's there.
So for anyone trying to square these two numbers, what's going on?
It's all about the cost of their big restructuring plan. The lower gap number includes all these one-time charges from their big AMP productivity program, which we'll get into.
So things like closing facilities, workforce reductions, that kind of thing.
Exactly. The street looks past that, though. They see the non-GAAP number as a cleaner look at the company's real, ongoing profitability. So in a way, that lower GAAP number is just the price they paid to get to the higher quality earnings the market liked so much.
That makes sense. Now, on revenue, even though they beat estimates, overall sales were actually down just under 1% year over year.
Right, which sounds weird, doesn't it? A beat. But sales are down.
Yeah.
But management was very clear this was intentional. It was portfolio shaping, as they call it. It's the drag from selling off some company-owned dealers and the Pope product line.
So they're shedding lower margin businesses to focus on the core.
Precisely. They're trading a little bit of top-line revenue now for better profitability down the road, and you can really see where that's paying off.
In cash flow, I assume. That was the number that really jumped out at me.
Yeah.
A record $578 million in free cash flow for the full year.
I mean, that is just an extraordinary number. It resulted in a free cash flow conversion rate of 146%.
Wow.
Generating that kind of cash in this environment, it's just a massive sign of incredible operational discipline.
Okay, but 146%, how sustainable is that really? Isn't some of that just a one-time benefit from supply chains finally normalizing?
That's a great point. And yes, a rate that high is definitely not repeatable every single year. A lot of that comes from, burning down excess inventory.
Right.
But the key thing is what they guided for next year. They're still expecting conversion to be greater than 110%. So that tells you this high cash generation, it's the new baseline. It's not just a fluke.
And they're putting that cash to work. $441 million returned to shareholders through dividends and buybacks.
And that's really the sign of a healthy, self-sufficient company. They can fund their own growth, invest in innovation, and still return a massive amount of capital to shareholders. It's what you want to see.
Yeah, okay, so let's get into the segments. That cash has to come from somewhere, and it seems like the professional segment is really the engine here.
It's the whole story. It's 80% of the portfolio, and the full-year earnings margin there was an incredible 19.4%.
19.4, so this part of the business is just humming along.
It really is. They saw a lot of strength in underground construction, which is, benefiting from all the infrastructure spending. And they also got a nice little boost from snow and ice management. Dealers were stocking up early for the winter.
So the pro side is protected by these big multi-year trends, golf courses, infrastructure.
Exactly, which is the complete opposite of what's happening on the residential side. That's the real weak spot.
Yeah, full year sales were down 14% there.
And that's just a straight line back to inflation and high interest rates. The average homeowner is feeling squeezed, and buying a big new mower just isn't a priority.
It's a discretionary purchase, and right now, there's not a lot of discretion.
None at all. And that's why their internal cost control is so important. Yeah. Which brings us to really the star of the show, the AMP program.
Amplifying maximum productivity.
Yep. And this is central to the whole bull case for the stock. They just raised their savings target for this program.
They did. Up to $125 million or more by the end of fiscal 26. That's a big jump from the original $100 million goal.
It's a huge jump, and they have the credibility to say that because they're already delivering. The current run rate savings is already at $86 million.
So how are they getting there? This isn't just trimming the edges, is it?
No, not at all. This is deep structural change. They've closed over 1 million square feet of facility space. They cut the salaried workforce by nearly 15%. I mean, this is a fundamental redesign of their cost structure.
So are they just dropping all those savings to the bottom line?
No, and this is the really smart part. They said they plan to reinvest up to half of those savings.
50%.
Right, 50% back into innovation and growth. The other half is for margin protection. It's a flywheel. Use today's efficiency to pay for tomorrow's growth.
Okay, speaking of growth, they closed an acquisition in Q4, Tornado Infrastructure Technologies. What's the strategy there?
It's a perfect bolt-on. Tornado makes vacuum excavation equipment. It fits right into that booming underground construction segment we were just talking about.
So it's a niche, but a very profitable one right now.
A very profitable one. They expect it to add about 2% to sales and be slightly accretive to EPS. Now, they did warn it's going to trim the pro segment margins in the short term.
Just from integration costs and things like that.
Exactly. Just normal transaction stuff. It's a short-term hit for a long-term gain.
And that reinvestment in innovation you mentioned, that seems critical right now. All their commercial customers are dealing with major labor shortages.
It's the #1 issue. Technology is no longer a feature, it's a solution. And that's where things like their GeoLink autonomous fairway mower come in. They said customer feedback has been extremely positive.
I can imagine. If you can't find people to mow the fairways, a robot starts to look pretty good.
It's the only option. And same with their Grandstand multi-force system. It lets one machine do the job of 3 or 4. It's all about productivity.
Let's shift to the supply chain for a minute. For years, we've heard about insane lead times. Is that finally over?
It seems to be, yeah. Management said channel inventory is in good shape. And more importantly, lead times are back to a normal 60 to 90 days.
60 to 90, down from, what, 2 years in some cases?
Oh, yeah. It was chaos. This is a huge return to normalcy for them and their dealers.
Okay, but usually when lead times shrink, the backlog just evaporates. But theirs actually improved by $400 million year over year. How does that work?
That is such a powerful signal. It tells you that the demand in their professional segments is real and durable. It's not just leftover pandemic noise. The fact that the backlog is holding up even when they can ship product faster means the underlying structural demand is very, very strong.
Okay, so a lot of positives on the operational side. Let's talk about the future. What did the guidance look like, and what are the big headwinds baked into it?
The guidance for fiscal 26 was, I'd say, cautiously optimistic. Net sales growth of 2 to 5%.
Okay.
Adjusted EPS between $4.35 and $4.50, so mid-single-digit growth. And that strong free cash flow conversion we talked about, still over 110%.
And the pro segment margin, still very healthy in that 18.5 to 19.5% range.
Right. A little muted from this year, probably because of the Tornado acquisition, like we said. But the big number, the real red flag that the market seized on, was the tariff impact.
They quantified it, right?
They did. They're expecting a $100 million headwind from tariffs in fiscal 26.
$100 million. How big is that in the grand scheme of things for TTC?
It's very significant. I mean, that's up from about $65 million this past year. It's mostly steel, aluminum, and China-related tariffs. So you have to understand, they have to find $100 million in savings or price increases just to stay flat before any of their growth even kicks in.
And that caution extends to the first quarter, Q1 as well.
They're guiding Q1 sales up slightly, but adjusted EPS is actually expected to be flat to slightly down.
Why the drop?
It's a combination of seasonal costs, and crucially, they expect residential sales to be down in the high teens in the first quarter. The benefits from the AMP program are really more of a second-half story.
So this all brings us back to where we started, that market reaction. The huge 10.7% pop on the news.
Followed by the 2.7% fade.
It sounds like the market cheered the operational control, the cash flow, the AMP program. And then they did the math on the $100 million tariff and the weak residential outlook and got nervous.
That's it in a nutshell. The pop was the internal story of a well-run company. The fade was the external story of macro risks they can't control. It's that classic battle between certainty and uncertainty.
Well, that divergence between a strong operational floor and a capped macro ceiling is a perfect setup for our not financial advice segment. So what's the wild but plausible trade idea that monetizes this exact dynamic?
Okay, so the thesis is simple. The company's operational excellence provides a really strong floor for the stock price. That cash flow isn't going anywhere. But those big known headwinds, the tariffs, the weak consumer, they put a pretty firm cap on any explosive near-term upside.
So protected on the downside, capped on the upside. How do you trade that?
The structure is to own the stock, so you go long TTC equity. But you help fund that purchase by selling long-dated call options against your position.
So shorting the calls.
Exactly. For example, you could sell calls that are, say, 10% out of the money, with maybe 18 months until expiration. You're basically selling the market's hope for a massive, quick breakout.
So you're saying, I believe in the company long term because of the AMP savings and the cash flow, so I'll buy the stock.
Yeah.
But I don't think it's going to scream 10% higher in the next year and a half because of the tariff headwind. So I'll sell that possibility to someone else and collect the premium.
That's the trade. You're selling the market's overpriced fear and volatility. You collect that option premium, which lowers your cost basis on the stock you own, and you just sit back and let the company's high-quality operational story compound over time. You're betting on execution, not on a sudden macro miracle.
That is a very interesting way to play the gap between management's certainty and the market's skepticism. All right, to wrap this up, a really solid quarter from TTC, driven almost entirely by incredible operational discipline. The AMP program is delivering, the cash is flowing, and the professional segment is as strong as ever, even while residential struggles.
Yeah, and I think the real provocative thought to leave you with is about the long-term picture. You have this company making huge investments in things like the GeoLink autonomous mower to solve a permanent labor problem for their customers. At the same time, they're fighting this $100 million headwind from tariffs. So the question is, 5 years from now, which one of those things will have had a bigger impact on their competitive position? The short-term tariff problem or the long-term foundational shift to autonomy? I think the answer to that is the real measure of their future success.